Welcome to Balance of Economy. Before we break down the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. All right, let's dive right into this explainer. For the last 3 years, the entire tech sector's playbook has basically operated on one simple, highly profitable mandate: brute force buying of AI hardware. But we're rapidly speeding towards a massive structural roadblock. We're hitting what we call the AI inference wall, and trust me, it is sending a multi-billion-dollar shockwave straight through the core of the market.
Just think about this staggering number for a second. In NVIDIA's recent Q1 fiscal 2027 earnings report, they delivered a mathematically flawless $81.62 billion in revenue. I mean, they absolutely crushed Wall Street expectations by billions. But here is the crucial catch. Despite that monumental revenue beat, the stock price essentially stalled. The momentum completely paused. So, what does this tell us? It's a massive, flashing warning light. It signals that the era of the market blindly pricing in endless, infinite AI training capacity, that's officially over. The smart money is already moving on to the next phase.
We are witnessing a fundamental paradigm shift right now. To really understand why the current hardware monopoly is suddenly looking incredibly vulnerable, we have to draw a hard line between training and inference. Training a massive model like GPT-5 is a one-time, highly capital-intensive infrastructure build. You're chaining together thousands of expensive GPUs in a giant data center and running them at absolute maximum capacity for months. But inference? Inference is mass-scale, continuous daily deployment. It is the physical execution of the model. It's every single time a user queries an AI, every time your smartphone runs a local generative task, or a self-driving car scans a crosswalk.
Let's map this out on a timeline to see exactly how this builds into an economic inflection point. We all just lived through the 2023 to 2025 training boom, but right now, sitting right here in the middle of 2026, we are hitting the historical capex flip. According to strict industry data, 2026 is the exact year where global spending on AI inference hardware officially surpasses spending on training hardware. Capital expenditures are completely flipping from just building the models to actually running them in the real world.
And this transition opens up an absolutely massive financial arena. By 2030, the global inference market is projected to expand into a $253 billion space. We're talking about $250 billion up for grabs, not for building new AI brains, but purely for putting them to work. But doing this at scale requires a completely different type of computing architecture.
Section 1. The physics of the bottleneck.
It really all boils down to this: the cost per token problem. When you are serving an AI model to hundreds of millions of concurrent users, inference doesn't actually need raw monolithic computing power. It demands ultra-low latency, maximum memory bandwidth, and absolutely relentless cost efficiency. Running scaled AI is a crushing operational expense. Right now, if you're using general-purpose hardware, the cost per token is literally eating software gross margins alive. Mathematically, it is just unsustainable for the long term. Which leads us straight to the harsh physical reality of the hardware. In the architecture of inference, the primary bottleneck is no longer the processing core, it is the memory pipe. Think about it. If you have a lightning-fast processor, but it has to wait around for data to squeeze through a narrow memory pipe, what happens? The chip just sits there, idle. It wastes incredibly expensive electricity while it waits for instructions. When margins are tight, wasted data center electricity is a direct hit to the balance sheet.
Section 2. The hardware rebellions.
First up, we're seeing a direct commercial hardware attack from AMD. They are zeroing in directly on NVIDIA Blackwell's narrow memory pipe. Deploying in late 2026 on their CDNA 5 architecture, the AMD Instinct MI400 series packs a massive 432 gigabytes of HBM4 memory and is staggering 19.6 terabytes per second of bandwidth. By dramatically widening that memory pipe, AMD allows enterprises to run frontier-level models on a much smaller physical footprint, which drastically lowers the total cost of ownership. The hardware gap is closing with brutal speed.
And while AMD attacks from the commercial side, the tech hyperscalers are attacking from within. At Google Cloud Next 26, Google unveiled a surgical strike on inference costs with its 8th-generation custom silicon. They intentionally split their architecture in two. They built the TPU-8T specifically for training, and they co-designed a completely separate chip with Broadcom, the TPU-8i, built exclusively for infrastructure inference at mass scale. They are taking their destiny and their profit margins entirely into their own hands.
Now, why is Google splitting its chips like this? Well, it's because we are officially entering the agentic era. This isn't just about chatbots anymore. We're talking about autonomous AI agents running continuously in the background,
executing complex, multi-step workflows without constant human prompting. Google's custom TPU 8i is built to deliver an 80% performance increase with near-zero latency specifically for this kind of constant background execution. General-purpose GPUs simply cannot match this cost-per-token profile for agentic workflows.
Section 3. The software fracture.
This number right here is the stark reality of the software margin crush, 17%. Enterprise software giant Intuit recently saw its stock collapse by over 13% after missing revenue expectations, and their immediate response was to lay off 17% of their global workforce. This is exactly what happens when the high-flying virtual economy of AI slams into the cold parameters of physical execution.
The corporate message echoing across the sector right now is crystal clear. Companies can no longer afford to blindly spend on expensive hardware without generating highly efficient software revenues. The market's tolerance for burning cash on expensive general-purpose GPU computing hours is evaporating. Software companies are demanding cheaper inference alternatives, and it's accelerating a massive market flight away from extended megacap hardware stocks.
Section 4. Hunting hidden tech value. So, to find these assets without stepping right into a valuation bubble, institutions are deploying a very specific 4-pillar quantitative screening process. Let's step through this meticulously. Step 1 is a hard $3 billion market cap floor, ensuring proper liquidity and eliminating microcap risk. Step 2 requires a minimum 20% intrinsic discount below fair value, which gives an immediate margin of safety. Step 3 looks for a 50% analyst disconnect, meaning the stock has massive structural upside based on consensus price targets. And finally, Step 4 demands a strict financial and cash flow health score greater than 2.5 out of 5, immediately stripping out the unprofitable hype companies.
And what actually passes this rigorous, mathematically sound test? Companies like Pegasystems. Take a look at this valuation. They are trading at just 11.7 times forward earnings. But more importantly, they are maintaining a massive 75% gross margin in the enterprise automation space. This is a prime example of the exact type of fundamentally secure, mathematically sound alternative that institutional value allocators are rotating into right as the hardware bubble begins to face its physical constraints.
The compute landscape is permanently shifting from brute force training to cost-sensitive, high-volume inference. In a market this split, you are either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed.